In this final phase of the accounting cycle, we close the books. That is, we reset the balances of our temporary accounts to zero so that we can start afresh for the next period. Let's take a closer look. Here we see Saul Goodman's chart of accounts, which he created when he formed his law business. The chart of accounts lists the title of each of the accounts in a business accounting system. We group the different account titles in order of the 6 major components of the expanded accounting equation. That is our assets, our liabilities, and our equities, which comprise the balance sheet accounts, as well as our revenue and expenses. A 6th category for dividends doesn't appear on this trial balance because Saul did not record any activity in that account during the preceding month. At the end of the period, we close the books by zeroing out our temporary accounts into one of our permanent accounts. The temporary accounts include the revenue and expense accounts found on the income statement, whereas the permanent accounts are the accounts that appear on the balance sheet. This is logical given the nature of the statements. The balance sheet reflects the position of the entity at any given time. Therefore, the accounts stay open for all the time. The income statement is what's called a flow statement. It reflects the activity that flows through the entity at a given time period. Therefore, at the end of that time period, they have to go back to zero so that the activity can flow through again. Closing the books has 3 steps. First, identify the normal balance of the temporary account that you're closing. Our revenue accounts normally have a credit balance, and our expense accounts normally have a debit balance. In the second step, you reverse the temporary accounts to the retained earnings account. That is, to close out your sales account, you record a debit transaction in the amount of the total sales recorded during the preceding period, and you credit retained earnings for that same amount. This is shown in the graphic at right. Once you've computed all of those journal entries and updated the ledgers, compute the new balance of your temporary accounts and the balance of the permanent account, your retained earnings account, that is impacted by your closing entries. Let's look at a couple of examples from Saul Goodman's books. Example number 1. During his first month of operations, Saul Goodman recorded $6,000 worth of legal revenue. Record the journal entry to close the revenue account. Our revenue accounts have an ordinary credit balance because they add to our retained earnings. To reverse the revenue at the end of the month and close out the account so that it has a zero balance to start the next month, we debit revenue for $6,000 and we credit retained earnings for that same amount. At the end of the period, our revenue account shows a zero balance. Once we've closed out all of Mr. Goodman's revenue accounts, we begin to close Mr. Goodman's expense accounts for his first month of operations. Mr. Goodman maintains a cost of goods sold account to record the various transactions associated with earning his legal revenue. At the end of the time period, his cost of goods sold account has a debit balance of $1,750. His retained earnings account currently reflects the $6,000 of revenue that we've closed to it. To reverse the cost of goods sold balance back to zero, we credit cost of goods sold for the total amount presented in the account at the end of the period. When we sum our beginning balance with the credit transaction that we just recorded, this brings our cost of goods sold balance back to zero. The offsetting transaction is a debit to retained earnings because our expense accounts serve as deductions from retained earnings. You'll recall from the trial balance that Saul also maintains an expense account for his consulting business expenses. This was $50 for the preceding period. He would reverse these account expenses in the same manner by crediting his consulting expense account and debiting retained earnings for the same amount. Another category of expenses that Mr. Goodman maintained was his malpractice insurance. Of the amount that he prepaid during his first month of operations, $100 worth had expired. We show $100 as a debit in the account to begin with, and we zero out the account by crediting that balance. Again, this brings our insurance expense account back to zero. Our offsetting debit entry is a $100 debit to retained earnings. We continue with this process for each of the transactions in Mr. Goodman's trial balance. The remaining transactions include $100 of depreciation expense, $1,000 salary that Mr. Goodman paid to himself and to his administrative assistant, $1,200 to cover the rent on his facility in that shopping center, and $100 of accrued utilities expense to pay for the electricity and the water in his office building. Each of these are debited to retained earnings and credited to their respective expense accounts. A third step would be taken if Mr. Goodman had paid any dividends during the preceding period. In this example, he did not. His dividend paid balance is zero. But had he paid dividends, he would have reversed it by recording a credit to dividends paid and an offsetting debit to retained earnings. But we could skip this process since he didn't pay any dividends this period. At the end of the period, we sum our revenue and expense accounts, which, if we recorded all of these transactions, should each have a balance of zero. We also summarize our retained earnings account. The sum of each of the expense transactions that we recorded during the preceding period was $4,300. We subtract this from our normal credit balance, which shows the revenue recorded during the preceding period of $6,000. This gives us a net difference of $1,700. And if you're thinking you've seen that number before, it's not a coincidence. The $1,700 is the same ending retained earnings amounts that we computed when we prepared our end of period financial statement. Voila! Once you've prepared all of your post-closing journal entries and computed the end balance in your retained earnings account, you would prepare a post-closing trial balance. This shows the balance in your permanent and temporary accounts. Our permanent accounts, to the extent that they've been utilized in Mr. Goodman's short business operations, each have a balance. The retained earnings account, which again is a reflection of the business activity that occurred during the prior period, now has a balance of $1,700, showing that Saul's business earned a profit in its first month of operation and that he plans to use this profit in his future business operations. Each of our temporary accounts have a zero balance so that Saul can start afresh, serving the people of Albuquerque as a, quote, criminal lawyer.